Hi everyone. In this video, we'll post 10 business transactions to a spreadsheet for Craven's consulting service. You will get the most benefit from this video lecture if you download and print the worksheets published for this lecture so you can follow along with the video and practice posting business transactions. To download the worksheets, click on the link directly above the video on this Canvas page. One of the primary purposes of this practice session is to understand how business transactions affect the accounts in the accounting equation. So taking a close look at the spreadsheet, can you see the accounting equation? Assets equals liabilities plus owner's equity minus draws plus revenue minus expenses. There is a separate column for each of the asset accounts: cash, accounts receivable, supplies, and office furniture. There's only one liability account, accounts payable. There are separate columns for Sherry Craven's capital and Sherry Craven's draws. There's a separate column for consulting revenue. But there's only one column for expenses. We will be working with a number of expense accounts, and rather than make this spreadsheet even wider than it is, we will post an expense amount here and then put the expense account title here. We will be recording the business transactions for the month of January. The balances at the beginning of the month are posted to the assets, liabilities, and capital account. $38,000 of cash at the beginning of the month, $12,000 in accounts receivable. Supplies had an $800 balance. Office furniture had a $24,000 balance. Accounts payable were $10,000, and Sherry Craven's capital was $64,800. We need to make sure that our books are in balance before we begin posting our January transactions. Do assets equals liabilities plus Sherry Craven's capital? Well, let's check it out. Does $38,000 plus $12,000 plus $800 plus $24,000 in assets equal this side of the equation? And the answer is yes. Our assets total $74,800, and liabilities plus capital also equals $74,800. So our books are in balance on January 1st before we begin posting our January business transactions. Now, before we begin the exercise, we need to talk a little bit about double entry accounting. Double entry accounting means that every business transaction will affect at least two accounts. More than two accounts could be affected, but at least two accounts will be always involved in posting a business transaction. And I think you'll see what that means as we start to practice. So let's read and analyze the first business transaction. Wrote a check for $1,500 for January's rent. What accounts are involved? Remember, there are always at least two. Well, we spent $1,500 in cash, so the cash account is involved and the balance will decrease because we spent the money. And looking at our chart of accounts for expenses, it looks like we have rent expense for the month of January. And before this business transaction, we had no balance on the books for rent expense. Now we get to increase the balance in the books for rent expense. So let's post the transaction. We have a $1,500 decrease in cash. Notice that I wrote the decrease as a negative number in brackets. And we have a $1,500 increase in rent expense. If we're going to increase in account balance, we're going to write it as a positive number. Decreases to account balances are written as negative numbers. Let's look at transaction number 2. Paid $1,700 in cash for new office chairs. What accounts are involved, and does their balance increase or decrease? Well, cash is involved because we spent the cash, so we're going to decrease cash for $1,700. Now, new office chairs is not an expense. Those chairs will benefit and be used by our company for a number of years to come, so it fits the definition of an asset. And let's see if we can find a good asset account title. Well, it looks to me like office furniture is perfect. So let's post the transaction. Decrease cash by $1,700 and increase office furniture $1,700. Transaction number 3. Received $11,200 in cash from credit clients. So what accounts are involved, and do their balances increase or decrease? Well, cash is involved because we received a check from our customers. So we're going to increase cash $11,200. Credit clients means customers who owe us money. Customers who owe us money, the balances is posted in an asset account called accounts receivable. So we're going to increase cash and decrease accounts receivable. Before this business transactions, our customers owed us $12,000. Now they've paid us $11,200, so we're going to decrease the accounts receivable. Let's post the transaction. Increase cash $11,200, decrease accounts receivable $11,200. Transaction number 4. We perform services $10,680 on credit. So what accounts are involved, and do their balances increase or decrease? When you perform services, that means that you have earned the income. So we're going to increase our consulting revenue account, but we didn't get the cash right away. We gave our customers time to pay the balance. So instead of increasing cash, we're going to increase accounts receivable. Increase accounts receivable $10,680. Increase consulting revenue $10,680. Transaction number 5. Sent a check for $6,500 in partial payment of the amount due to creditors. What accounts are involved, and does the balance increase or decrease? We sent a check. That means we spent the money. So cash is going to decrease. In partial payment to the amount due to our creditors. Well, our creditors' balance is $10,000. We owe our creditors $10,000 before this business transaction. Now we're paying part of that bill. So we're going to decrease accounts payable. Decrease cash $6,500. Decrease accounts payable $6,500. Why don't you pause this video and take a few minutes to record transactions number 6 through 10. When you are finished, start the video again to check your work. Transaction number 6. Paid salaries, $9,700 by check. We're going to decrease cash, $9,700, and increase salaries expense, $9,700. Transaction number 7, sent a check for $1,120 to pay for the electric bill. Decrease cash, $1,120. Increase utilities expense, $1,120. Number 8, paid $2,350 for auto repairs. Decrease cash, $2,350. Increase repairs expense, $2,350. Number 9, perform services for $12,500 on account. Increase accounts receivable, increase consulting revenue. And number 10, wrote a check to Sherry Cravens in the amount of $5,500 for personal use. Decrease cash, $5,500. Increase Sherry Cravens draws, $5,500. Did you get them all recorded correctly? If not, please pause this recording and take a moment to fix your spreadsheet. Okay, now that we have recorded the increases and/or decreases in account balances as a result of the business transactions for the month of January, we need to find the new balance in each account and see if our books are still in balance. Finding the new balance is very easy. Just add up the columns. So I get these new balances by adding and subtracting numbers in each column. Cash, $20,830. Accounts receivable, $23,980. Supplies didn't change. It still has an $800 balance. Office furniture, $25,700. Accounts payable, $3,500. Sherry Cravens capital didn't change. It's still $64,800. Draws is $5,500. Revenue, $23,180. And expenses total $14,670. Now let's check to see if our books are still in balance. Do assets equal liabilities plus equity minus draws plus revenue minus expenses? Well, if I total all of those 4 asset accounts, I get $71,310, and $3,500 plus $64,800 minus $5,500 plus $23,180 minus $14,670 also equals $71,310. So both sides of the equation equal the same dollar amount, and our books are in balance after posting the business transactions for the month of January. Well, that's all for this lecture. In the next Chapter 2 video, we'll use this spreadsheet to prepare financial statements for Cravens Consulting Company. See you next time.